Man, I wonder what's happening with the stocks this morning. Whoa, heaps of things are up. GrafTech, Fit Chrysler, Google's down a little bit, Monster's up, Apple's up, Facebook's up. Wonder what's happening with Tesla. Holy smokers! Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today is my probably about 102nd video that I've uploaded to YouTube, and I'm yet to make an entire video about Tesla. So I think that's pretty rare for a lot of investing YouTube channels out there. But today we're popping the Tesla cherry and diving in deep to what's happening at the moment. So as it stands, as I'm filming this video, Tesla is around $920 a share. The thing has just gone parabolic since only about 6 months ago when it was trading for less than $200 a share. And I'm sure many of you are probably Tesla shareholders. I know it's a very common stock owned by young individuals at the moment, which a lot of the people watching this video sort of fall into that category. So I'm guessing a lot of you probably do own it. I don't personally. And about a month ago, I put up a video around a 2020 stock picking competition, and I actually went short Tesla in that competition. So I really thought that could go one of two ways. You know, if Tesla did go down and I was sort of correct on that short, we could make a cool video about, you know, how in the short term, the stock market is a voting machine. In the long term, the stock market is a weighing machine and will value all things appropriately and that kind of thing. And if it blew up on me, which it looks like it might just do so far, we could make a video about why we don't short stocks and some of the simple maths behind that. And some of the reasons why I don't choose to do that in practice. So I know we're only into February. We're 1 month into this 12-month competition, but it is not looking good for me, and also for about a third of the participants in that competition as well. That would be my guess as to how many of you actually also shorted Tesla. So a lot of us are getting our butts kicked on that one so far. So I thought it might be a good opportunity to make a video on it now. And talk a bit about the competition and you know, whether we should keep carrying on and get a 12-month lesson on why we shouldn't short stocks. So let's get into this. I hope you enjoyed the video. So here we go. So just before we get into the actual technical side of why I don't typically short, I just want to talk about Tesla specifically. There's been some really, really good things going on with the company itself in terms of their earnings. They've gone from a company that was losing a lot of money, accumulating debt, having to constantly raise capital, to a company that in the last quarter had about $1 billion of positive cash flow. And as a fundamental value style investor, that's exactly what you want to see. For me personally, there is just way too much potential downside with Tesla for me to even think about investing in it. A hell of a lot of people are going to disagree with me on that one. But up until very recently, I mean, the prospects of Tesla going bankrupt were very real. They were accumulating a lot of debt, losing a lot of money every single quarter. And although things have turned around, they've still got a pretty hefty amount of leverage. And even if we put that aside, you know, they're now trading at a market cap of like $140 billion. It's magnitudes higher than any other company in its sector and in its industry. And again, a lot of you know, people that are really bullish on Tesla will say, you know, Tesla is an entirely new thing. It's the next iPhone and all that kind of stuff. And they may well be right for the sake of the planet and the environment and all those things. I really hope you are right. But from an investment perspective, it's just eye-wateringly expensive. I thought it was eye-wateringly expensive when it was at half of this level, and now it's doubled again, and you know, I don't even know what to do other than to put this thing in the too hard basket and just carry on. I think that's what you've got to do in this situation. If it's not a hell yes when you're going into an investment, it's a no in my book. So you can't really be in two minds in the investment game unless you're like ridiculously diversified across a bunch of different stocks. So as far as my strategy, I am not going to be an owner of Tesla. But that's what's been happening. So they've suddenly, started to make a lot of money. They had the Shanghai Gigafactory well ahead of schedule. Model Y production looks like it's going to be ahead of schedule as well. And, the stock has been behaving pretty strangely. It's been going, vertical essentially just this last week. So I think there's probably a couple of things unrelated to the business that are driving that. And the main one being a short squeeze. So if you're unfamiliar with a short squeeze, let me first explain what short selling is. So short selling essentially is when you want to bet on a stock going down. And the way that you do that is you basically borrow the shares from someone else that already owns that stock, in this case Tesla. And you can pay that person, typically your broker, an interest rate for borrowing that stock. And essentially what you do is you sell that person's stock. So you borrow it from them, you sell it, and then you hope that the shares go down, get cheaper. You can then buy them back cheaper than you sold them for, and you can kind of pocket that difference. So that's fundamentally what short selling is about. So on the absolute best case for a short seller, best case scenario, you essentially take those shares from someone else, you borrow them, and you sell them at, let's say, $100 a share. And then the company goes bankrupt, it goes down to zero, and you basically pocket that $100 difference. So that's the absolute best case scenario for a short seller, is you make 100% return. So it goes from 100 to zero, and you're getting the kind of opposite return to that. Unfortunately, with short selling, if that is a game you like to play, if the stock goes the other direction, you are open to what are called margin calls and having to cover that position. So if that stock that you sell at 100 thinking it's going to go down to 70 or 50 or 30 actually goes the other direction and goes up to say 150, at a certain point you're going to want to do either one of two things. So you're either going to want to exit that position because you're getting your ass kicked in that investment, and that's what can cause a short squeeze. So a lot of people, short sellers, trying to buy those shares back when they think they're in trouble and trying to get out of that short position, and that puts a lot of buying pressure on the stock, sending it vertical. And I think this is a big driver of what's happening with Tesla, is people covering that short position. The other thing is, often with short selling, you can get forced to cover that short position. So your broker will call you and say, you just don't have enough equity in this deal, you are losing too much money, and I'm going to force you to buy those shares back now and exit this position, because I don't want you to go bankrupt and not be able to pay me and my client back who you're borrowing these shares from. So that's probably the other thing that's happening here, is we're just seeing a massive short squeeze, in my opinion. There's a whole bunch of buying pressure on the stock, next to no selling pressure, and that can only send prices one way. So that's Tesla. Let's get into short selling more generally, and hopefully we can teach some lessons on that one. So there's a lecture out there from an investor that I'm a huge fan of by the name of Pabrai. I've got his book behind me here, The Dundo Investor. I'm planning to reread that this year because it is really good. So recommend reading that one if you haven't before. But Mohnish Pabrai gave a lecture last year, and all of these videos that he does are on his YouTube channel, so go and look up Mohnish Pabrai. I'll leave the link to the lecture I'm talking about here in the description below. And he gave this lecture last year to a group of business students, and the talk was called The 10 Commandments of Investment Management. And one of those 10 commandments was, thou shalt never short a stock. And there's a couple of mathematical reasons for that, and a couple of sort of psychological reasons for that. So the maths we've already touched on a little bit. So absolute best case scenario for a short seller is you can make 100% return. Worst case scenario is you can make an infinite loss. So there is a limit to how much a stock can go down, which caps your upside, but there is no limit to how high a stock can go, which can, give you an infinite downside if you're a short seller. So from an investment perspective, that is not a bet you typically are going to want to make, one where you've got infinite downside, and a double is the absolute best case scenario. Ideally, you'd want to flip that and have, potentially many multiples of your money being the upside, losing 100% of that investment being the absolute worst case scenario. You don't want to be in a situation where you invest $1,000 and you lose $3,000 because you're a short seller and the price just keeps going up. So that's the first basic thing on the maths. The second thing is to do with the stock market being irrational. So there's a theory out there called the efficient market hypothesis or efficient market theory, which basically says that all stocks are priced at their value at all times. Information is out there and available to everyone at the same time with the internet these days and all that sort of thing. And it basically says that because of that, you cannot get a deal. Everything is priced efficiently. You can't underpay for a stock, so you can't buy it cheaply. You can't overpay for a stock. You can't, buy it for too much and all these different things. And frankly, we know that that's not true. We know that there's a lot of very famous value investors out there that have bought undervalued stocks their whole lives and done very well. And there's some people who have shorted overvalued stocks as a portion of their portfolio their whole lives and have done well also. Now, the great thing about that strategy is that Ben Graham, the father of value investing, has this quote that in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine, which basically means that stock prices short term can be driven by just investor sentiment and how well the market thinks that company is going to do. But over the long term, it's very, very unlikely that the performance of the stock will be largely disconnected to the performance of the business. Over time, the business results will be what drive the stock investment results. And that is great in a long situation. So when you just straight up buy shares and hold them for a very long time. If you're planning to hold something for 20 years, it doesn't really matter if it goes up 50% as soon as you buy it or down 50% as soon as you buy it. Over the long term, if you are correct on the business, things will work out okay, and that's fine as a long. As a short seller, unfortunately, you have some sort of market irrationality risk. So if you short something at 100 and you know for certain that that company is going to go bankrupt, even if you are 100% correct and 5 years later that company does go bankrupt, in the meantime that stock can double or triple or quadruple and you can get your butt handed to you in that investment. So that's not something you want to be exposed to that risk of having to time the market correctly in order to be correct. And that's one of the reasons why most value investors, I would say, do not short. Warren Buffett and Charlie Munger do not short. They have done a little bit way back in the day, but they don't anymore. Pabrai doesn't short, Spier doesn't short, Phil Town, as far as I know, does not short shares. And those are a couple of reasons why. So that's short selling. I just want to talk for a quick couple of minutes on the competition that we ran, just to get your thoughts on what we should be doing there. So I'm planning on making the first sort of update video just to go through everyone's picks sometime in the next few days, or at least in the next week. And I just wanted to talk to you about some of the rules. So like I said, about a third of us went short Tesla and have basically gone to zero on that side of the portfolio in a month. So well done to us. That's a great lesson why we shouldn't short. So I've basically got two options. I'm pretty keen personally to just stick with the original rules of the competition and see how it plays out over the next 12 months and have this be a really good lesson on why we don't short shares in practice. And I hope none of you are actually short Tesla in this example. So that's option one. Option two is we just forget about the short side and only focus on the longs. A couple of you are long Tesla and will be doing very well in that at the moment. Or I guess the third option is we give prizes for both. So we give prizes for an overall portfolio value, people who did the best on the combination of a long and a short pick, and maybe we give prizes on people who did well just on the long side and just on the short side. So there's a few options in there. I'm keen to get your thoughts, so drop them down below. But like I say, I'll make an update video on that soon, going through everyone's picks. There's some pretty interesting stocks in there, plenty I have heard of, plenty I've never heard of. So yeah, it should be a fun competition. But that's my thoughts on short selling and what's going on with this crazy Tesla thing at the moment. So hope you enjoyed the video. If you did, like I say, hit like, hit subscribe. You can watch other videos over there. Hit subscribe over there if you haven't already. Otherwise, I will see you in the next one. So have a great day. Cheers.